Hello, this is Michael Swanson of WallStreetWindow.com. Speaking with a very special guest today. Speaking with David Skarica, who runs the website addictedtoprofits.net. How you doing today, Dave?
Good. Thanks for having me, Mike.
Well, we haven't spoken for several weeks now. It's been before the election since we've done one of our Google Hangout videos. So I just wanted to touch base with you really quickly and see what your thoughts are initially after the election with the financial markets.
Well, the election is really interesting because I think this is a huge shift. And I know most people will just say, oh, there's no difference. And because we've gone through this for decades and decades where there really has been no difference. Like in terms of who's running things and the actual policies, both foreign policy and, financial monetary policy. But see, every few decades, there is a shift. And, in the 30s, there was a shift towards more political power under Roosevelt, from, the power before that was on Wall Street and in finance and in the markets. And then when the markets collapsed, he shifted power and, started a lot of the programs that we have today, the safety nets, and of course did, a big, the New Deal and a big infrastructure project, et cetera. And then the next shift was in the 70s and 80s when at first the oil embargo gave these oil sheiks in the Middle East all this money, and then they in turn gave the money to bankers to invest it all over the world, giving financial institutions more power. And then when Reagan and Thatcher deregulated and then kind of took down a lot of the power that unions had, and that gave powers back kind of to the markets. And then obviously then you had China and India coming up. So, you had this big, basically a third of the world, with cheap labor and coming into the open free market, even more if you include Eastern Europe and other countries in Asia that were closed off. So that kind of started this globalization power. And I think now we're seeing a shift maybe back to more government power. And it's different than Roosevelt because, Roosevelt was kind of, a moderate left Democrat, where this kind of government power is this form of populism. And the populism will take on different forms. Bernie Sanders was kind of a socialist left-wing populist, and Trump is a right-wing authoritarian populist. And a lot of the populist movements in Europe, for example, are, right-wing authoritarian. And for example, in Greece, though, they kind of elected a couple of years ago, they elected a left-wing kind of populist government. So it's going to take different forms, but I think in the end, the real shift is towards maybe more political management of the economy, a kind of avert against globalization, against moving your factories to Vietnam or Thailand or whatever for cheap purposes of cheap labor. I think that's the shift here. So I made a lot of adjustments after the election. Obviously, I've been bearish the last couple of years, but I get in and out of positions because it's difficult to be bearish when the central banks were all basically behind trying to prop up asset markets. But after the election, when the futures were down 700 or 800 points overnight, and I saw no continuation of the sell-off Wednesday, I basically made a big shift on Wednesday and Thursday. I got rid of my small cap shorts because I figured the Trump policies would help domestically based smaller companies in the short term. And then I added shorts to things I think thought could drop, without the market, even if the market went up. And for example, one of those shorts would have been, I put on an oil short, and it looks like oil might be rolling over, and it looks like this OPEC meeting is turning into another disaster this upcoming week. So I kind of did more strategic shorts rather than market shorts. And then I went long a couple beat up companies. And I think the market now is very overbought. The bullishness is extreme. And one of the analogies I'm using towards, in the last shift, we're talking about Reagan, is people tend to forget because they act like Reagan was all these boom years. But the first year and a half when Reagan kind of made that shift, rates went up, the stock market went down. And actually what's interesting is there was a 6-year bull market from October of 1974 until November of 1980 that blew off when Reagan got elected. Very similar to now that you were in this long-term bull market coming out of a big bust and a bad recession, 6-7 years prior. And then the enthusiasm at first, because Reagan was going to be more pro-business, et cetera, just like people are viewing Trump, caused the market to blow off that November. Now, nothing's going to be exactly the same, and who knows, maybe the market can continue higher for a few more months. But I think with not knowing what's going on, and with this long-term shift I'm talking about is going to take years to play out, I think we're probably headed towards some sort of topping formation in the markets. I wouldn't really think the markets roll over bad till the second half of next year or 2018. But I definitely think that this shift is happening. Oh, and one of the other shifts I made is I lightened up my gold positions and even bought a gold stock bear fund to hedge the remaining gold positions I had. So I kind of made this short-term shift. But ultimately, the market is still very overvalued. Our stock market capitalization to GDP, which measures the market compared to the size of the economy, is as overvalued as it's been ever. I think the only time it was higher was the 2000 tech bubble. So we're very overvalued. I think that rates bottomed this past summer. So there's a lot of headwinds for stocks. And in the longer term, okay, these policies probably aren't very stock friendly. You know, I know people see Trump as pro-business, but I kind of see these populist movements as not really market friendly, especially when you're moving the power to political power. Like under Roosevelt, there was an initial rally from 33 to 37, but after that, really the stock market did nothing to when Roosevelt died in 1945. So I kind of think that these policies, even though short term they're being viewed this way, I think longer term they're not going to be, because I think that, remember, when you're a populist, Trump is going to, his people are going to clash with Wall Street and clash with certain industries and sectors. Like probably, with a company like Amazon, they're going to have issues with. So I think people have to realize this. But the twofold thing is, I think people really have to remember is, one, I really think this is one of these key political shifts. And it's not something like, oh, Trump's just going to be the same as Obama. He's going to be the same as Bush. And then number two, I think that the difference between Trump and Reagan, being in the early 80s, is stocks are so overvalued now. And back then we had double-digit interest rates. Now we have 2% interest rates. And those rates coming down really were a wind at Reagan and the stock market's back. And Trump does not have that luxury. And obviously the debt to GDP is a lot higher now and all of these things. So I think that people still have to look at that big term macro view. But what's going to be interesting going forward as part of this shift is I think the central banks around the world are going to lose a lot of the power that they have. They're the ones who've really kept the market alive with these zero rates, lowering money, making it very cheap, making companies able to borrow at almost nothing and buy back stock and financial engineer their earnings and all this sort of thing. And I think that era is coming lower, because actually last thing to end off here, one of Trump's policies, or the people his policymakers believe in, one of the aspects they believe in is they don't believe in zero rates. They don't believe in negative rates. And actually Mike was the one who sent me the articles on what some of these guys believe in, and I read them all. And it's really interesting because it's a big detour. And if you go look at Yellen's recent testimony, she made one testimony after the election. It was someone to me who really didn't know what was going on. Like, she probably lives in a Washington bubble, just like these people live in a Washington or LA or New York bubbles in the media centers. And what's probably happened is she never thought Trump probably had a chance. And now, she's probably gone in 14 months, number one. And number two, just look at the commentary. You don't believe me. You think, the Fed's always going to bail this out. It's never going to change. Well, the commentary, everyone's talking about Trump's policies. People are barely even mentioning the quarter-point interest rate hike that's probably going to come in mid-December. So that's kind of an interesting shift in itself. That, again, that shows the shift to political power, that people are talking about the fiscal policies, not so much the Fed policies.
Yeah, we really are in interesting times. And the day after the election, I too made lots of changes in my accounts, and then instantly, sent notices to the private premium members I have about what I was doing. But I closed out my short positions, and had been really short heavily this summer. But you have also put together a special comprehensive video. It's about 30 minutes long with charts and specific trading ideas in it. I'm going to put that up on the website Tuesday morning, so anyone listening go to see that, and they'll see, some of this information in detail, some specific ideas on how to profit from changes in the market. So, you talk about gold, you talk about commodities, you talk about all, just about every sector class we're all invested in or following.
Yeah, I just sorry to interrupt, but I give an idea. If you believe that the bonds have made a long-term top, I give an idea of a short, and it's a government bond, but it's outside the United States. So I give an idea for a short bond. I give an idea for this option strategy if you're interested in options. So I talk about my big picture and like the things that I've just discussed, and then I also give some trading ideas. And another thing that we're doing is because in the short term, I don't think the market's going to crash tomorrow. I do have a couple long ideas, very beaten up companies that I think can kind of rebound. And even if the market had a 10 or 15% correction, I think these companies actually could hold up because they're already so beaten up. They're really going to trade on the potential for the companies to turn around rather than the macro market. So anyhow, those are kind of the ideas that I give. And one thing I talk about with the themes, just as me and you are the big fan of this guy in the UK who works for the BBC named Adam Curtis. And he has a new film out called Hypernormalization. And just quick, because this can take a lot to explain, but basically that was a term used in the Soviet Union in the 70s because people were so used to the way things were, they couldn't see anything different happening. And the way I'm equating this hypernormalized market, people now are so used to the cheap money, so used to company buybacks driving it, so used to zero interest rates, they don't think there can be anything else. And I think these macro political shifts are ultimately going to change all that. So it's kind of what I talk about in there is adjusting for this kind of new normal, which I think is starting. And I think, and actually one aspect too of hypernormalization was people almost thought that the country, the system, everything was fake because people didn't really believe in it. And the equation I'm using is I think this has almost been a fake stock market for 2 years where earnings have been going down. But the only thing that's holding it up is they've kept rates at zero or in some countries negative rates. And these companies can basically borrow money for nothing and buy back stock and prop up the market. So I think it's almost in a way this kind of fake era of the stock market is going to come to an end.
Yeah, we're seeing light at the end of the tunnel for that. That's for sure. Well, again, people need to watch the video tomorrow. So you talk about everything they need to know in it, really. But so I'll just ask you one narrow question to finish this up. And I think really the most dramatic move we've seen in all the markets since the Trump election is the drop in Treasury bonds and spike up in long-term rates. And, the past couple of years, as you say, we've been in this like weird stock market propped up, but everyone, whether they're bullish or bearish, has been in this model where rates are low and the Fed will, the market drops, the Fed will print money or say something to make it go back up, and they look like they're going to raise rates one time a year. But now with Trump and this move in the long-term bonds, that game plan seems to be out the window. So what are your thoughts on that, where bonds might be going?
Well, my thoughts on that are I think this was the secular top in bonds. When I look at the amount of bonds that were in negative rates over the summer and have now come out of that, I don't think they're going to go right back into negative rates. I think that was the fact that we had so many bonds in negative rates was almost like that's the speculative blow off, right? And the thing about bonds is people aren't in bonds to get rich. So you don't see like what happened in 1999 and 2000 in the NASDAQ, people getting all excited, thinking they're going to be millionaires, this and that. It's just more this, to me, it was more this ultra complacency that people were looking at negative rates and thinking it was normal. And of course, we know that it wasn't. Talk about hypernormalization and fake. Well, those negative rates are about as fake as it got. in these highly indebted governments yielding negative. So I think that has stopped. And I think what will happen is you might get a bid in the U.S. bond if there's a big stock market decline, and they're definitely going to come back with a QE. Even though I said the Fed is going to lose power, let's also step back and look at the big picture. They're not going to stop from doing these things when there are downturns, right? So with these government bonds, I think the rates are higher. But what I think they're going to start seeing is the shift to political power will start negatively affecting the weaker country's bonds, right? Like if you look at Italy, they've got a vote, and not all populist movements are the same as Trump or the UK. What happened there? Remember, Trump and Farage are essentially the leaders of each of these movements. They're business people. They're people who believe in markets and capitalism, right? Where some of these populists don't quite believe in all that, and I think that can really start to negatively affect these bonds rates going forward. And a lot of these countries are even more indebted than the United States is. So I think that's kind of going to be the first thing to really crack in the bond market, that maybe something like Italy, and Italy's right near breaking down their bond, and the yield breaking higher, significantly higher. So I think, Italy could be the first one. Japan has stated they'll print as much money as possible to keep rates at zero, which ultimately could lead to the end continuing much lower. So what I'm saying is I think we saw this blow off, and I think you're going to see countries starting to get picked off. Maybe if there's another downturn in oil that affects all of these bonds that were issued to energy companies, I think you're going to see all those things roll over, and ultimately you're going to see the U.S. and even these other countries' bonds go much, much higher in yield, lower in price. Now, that could take years, but I just think this summer was the major blow-off in the bond market, which probably coincided with the major peak in central bank power, and the yields are going to be headed much, much higher. And I think part of the reason is, quite frankly, these populist movements just aren't going to be pro-central banks. They're going to actually blame the central banks for a lot of the problems when things begin to go haywire.
Yeah, it's going to be fascinating times to see what unfolds. That's for sure. And we got to stay on top of these markets and how they change. So thanks for taking the time to talk with me. And as I said, we'll post your video up on the website tomorrow for people to look at. Thanks again.
Yeah. Thank you very much.